Quick note about the audio. I need to get it out of the way and apologize. I completely messed this one up. So you might notice my audio sounds way worse than normal on this video. And that's because when I recorded the video, I didn't select the proper microphones. And so instead of recording from my microphone sitting right in front of my face right here and right here, it's recording the audio from a microphone set up on the other side of my office. So I apologize for that. And my editors did as good of a job as possible at making the audio sound at least to the point where you can understand what I'm saying. So I apologize in advance, and hopefully you can still enjoy the video. The second wave of bank failures may have just begun. First Republic bank shares have hit a new low after plunging almost 95% from their previous levels, with analysts actively telling investors they recommend selling their shares. Meanwhile, a credit crunch is slowly getting started as it rolls through the country. And finally, banks all across America are at risk due to the commercial real estate crisis. With offices all over the country half empty, anyone invested or exposed to commercial real estate, even pensions, are in trouble. As you might expect, this means depositors are also continuing to flee banks that they perceive to be high risk, moving into higher yielding instruments instead. So what is going on with First Republic? Currently, their shares are down about 95%, and that's from an additional sell-off recently over the last few days, driven by factors like the government signaling they are probably not going to intervene. Now, I've said this before and I'll say it again, but all banks operate the exact same way, meaning they don't have your money. Otherwise, they wouldn't be a bank. You give them $1 and they take that dollar and they loan it out to somebody else. That's what they do with all dollars, and that's what it means to be a bank. That means if you and everybody else who gave that bank $1 go to that bank and say, hey, give me that dollar back, they can't give it back to you. The only way they could try and give all those dollars back is if they go to all those assets that they created when they loaned that money out, those loans, they sell them all to other investors, and then they're able to take that money and give it back to you. But if those loans are worth less today than they were when they were created, then that bank does not have enough to meet all the deposit withdrawals. This is why First Republic has been forced to sell its assets. Now, both depositors and shareholders are looking at this as a big risk, because if you're a depositor, you're saying, I want to make sure I can get my money back. So you're going to pull your money out and you're going to move it to somewhere else that's safer. This puts more stress on the bank, and then that forces more people to think that they should pull their money out, which again puts more stress on the bank. But as an investor, you're also taking a look at this and thinking, I'm at risk here if I own these shares, because the government is reluctant to intervene with First Republic. And likely even if they do intervene, it'll be to save the depositors, not the shareholders, similar to how they dealt with Silicon Valley. And this is why analysts are recommending that investors sell their shares right now. But it's not just First Republic. Many other banks are facing the exact same pressures right now, like PacWest, which so far deposits have stabilized, but their shares have still taken a massive hit from where they were before the banking trouble started. Again, this is driven by a flurry of withdrawals that happened in March. So why in the world are depositors moving money out? Well, obviously we have the first issue, which is depositors look at their bank and they think, now my money might not be safe there, because it's not. Otherwise, it wouldn't be a bank. For it to be a bank, it means your money is not actually there. And after Janet Yellen and Jerome Powell came out over the last month and specifically said, we will not guarantee all deposits across the banking system, but only those in banks that are deemed systemically important, this means depositors are likely a little bit more afraid than they would have been otherwise. If your bank goes under, and there's no big investors there that make big political donations and contribute a lot to campaigns, then that bank just might not get bailed out. But the other piece of this is yields, the interest rate that you are getting paid on your deposits. This is one of the reasons why money market funds have drawn so many billions in inflows for so many weeks now, even attracting money from crypto assets, and why Apple's launch of its high yield savings account is likely to have a lot of success. Basically, right now, if you have a normal checking or savings account, you might be earning 0.01 to 1% interest. But if you were to move to a money market fund or one of these newer high yield savings accounts like at Apple, they're paying 4 to 5%. They're able to do this because they're not locked into those losses from before like most banks are. 2 years ago, the treasury rates for 2-year treasuries were down almost at 0%. So 2 years ago, if you gave your dollar to a bank and they loaned it to the government, they were going to earn, let's say, 0.1%. There wasn't a lot that they could pass back to you. And they're locked into that rate until that bond matures 2 years from then. And if they made an even worse decision by investing in a 10-year treasury bond, which was paying around 1.5%, they're going to be locked into that 1.5% for the next 8 years. And so that's why a lot of these banks are not able to offer higher yields on their checking and savings accounts right now, because a couple of years ago, when rates were really low, they loaded up on a bunch of debt, loaned all that money out, and are now locked in to those rates until those bonds mature. This is not the case with money market funds or some of these new high yield savings accounts, which only invest in the shortest term debt. Right now, the 3-month T-bill is yielding over 5%. And so these money market funds in Apple's new account, they're only investing in the shortest term bonds here, and they're getting a higher yield that they can pass through to you. They're not locked into anything from a couple of years ago. All this means that because of the fear of your bank collapsing and the attractiveness of some of these other higher yielding options to help out with the sting of inflation, means that many banks are experiencing massive withdrawals, and it doesn't look like that's set to slow down anytime soon. As a result of this, banks nationwide are starting to lead a credit crunch. This credit crunch may be a slow-moving credit crunch, but analysts think that it will severely impact small to medium-sized businesses, especially across small-town America. And this is happening because banks are tightening their lending by the most on record. If a bank has to worry about you taking your dollar back, they have to be careful with what they do with your dollar. So instead of lending it out to a business that might produce a better return for them, they're going to start doing the very conservative things like maybe a 1-month T-bill or a 3-month T-bill. Essentially, all this means is that businesses, especially small and medium-sized businesses, have less access to funding and capital compared to before. As businesses have less access to funding, that means they can't spend as much as they were spending before, which means other people don't have as much income as they had before. And when other people don't have as much income, that means businesses don't have as much income because those people can't spend as much money. When those businesses don't have as much income, that means they can't spend enough and they can't rely on the debt because, again, the credit crunch. So it's all a big downward spiral. As if that wasn't enough, the last piece of this puzzle is the commercial real estate crisis right now. American offices all over the country are empty or half empty. This is one trend that doesn't look like it's going away anytime soon, that 2020 kicked off and now looks like it's here to stay. Employees love work from home, and it doesn't look like there's anything that large companies can do to get their employees to come back to the office. And why would you want to? Many times your employees are happier and more productive. So other than the giant loss on this commercial real estate space, it is actually a win-win. But it goes beyond just work from home. Basically, all commercial real estate is funded with variable short-term loans. And by the end of 2025, almost $1.5 trillion of United States commercial real estate debt is coming due. Let me repeat that. By the end of 2025, in a year and a half from now, there is $1.5 trillion worth of commercial real estate debt that needs to get dealt with. In the past, commercial real estate debt just gets refinanced whenever that balloon payment comes up, because these are 7 to 10 year loans, or whenever the interest rate adjusts higher, the operators will just refinance or they'll sell the property. But property values on commercial real estate have not been going up, and so they can't sell enough to cover the debt. But they also aren't making enough on the property to be able to afford refinancing since rates are higher. And when $1.5 trillion of debt is coming due, and the people who are going to have to pay it back, refinance, sell it back, if they're not able to do that and their only choice is to default, who's in trouble there? The borrower or the lender? Well, considering the staggering size of this at $1.5 trillion, and considering the fact that most of this debt is held by small and regional banks, it's the banks that are in trouble. As a classic saying goes, if you're $1 million in debt, the bank owns you. But if you're $1 billion in debt, you own the bank. So as of right now, it does not look like the banking trouble in the United States is gone, is fixed, but it looks like right now just might be the eye of the storm as we enter the second wave. The likely outcomes of this are more and more small bank failures and consolidation among the biggest banks. And once we get to a situation where our country has 6 or 7 massive banks for all bank accounts in the entire country, it's that much easier to switch everything over to a CBDC. And if you would like more information about how I am constructing my portfolio and what I am doing to choose investments, get my money outside of the financial system, check out Heresy Financial University, linked in the description below, where you'll get access to an ever-expanding library of courses where I'm teaching you all about what I know about how to make money, keep more of your money, and protect your money. As always, really appreciate you guys. Thanks so much for watching. Have a great day.